This is significant. Tesla profits dropping 71% in the first quarter. That is not good.
The biggest shocker on Wall Street is Tesla. 71% drop in profits while its automotive revenue fell by 20%.
Political sentiment could have a meaningful impact on demand for our products.
Tesla used to be unstoppable. Now it's a warning sign. In the first quarter of the year 2025, Tesla posted a 71% collapse in net income. While the electric vehicle market grew, Tesla shrank badly. Meanwhile, factories kept building vehicles no one was buying. 336,000 vehicles delivered, 13% down. So, what really caused Tesla to nosedive while the market soared? Why are over 10,000 Cybertrucks collecting dust in silence? And how did Elon Musk's empire become Wall Street's biggest liability? Keep watching, because what's happening inside Tesla right now could trigger something bigger, a full-blown industrial realignment. When Wall Street blinked, the financial markets have a peculiar rhythm. While mainstream investors anxiously watch Tesla's earnings, seasoned institutional players moved with quiet urgency. They were not waiting, they were exiting. Behind calm voices on conference calls, hedge funds, pension managers, and mutual fund giants began scaling back their Tesla exposure methodically. Tesla's share price had rebounded 60% from its April lows, approaching $354. Financial news outlets celebrated the recovery, spinning tales of renewed optimism driven by artificial intelligence developments and new product rumors. Yet the recovery was built on shallow ground. Trading volumes told the real story. Large investors were offloading shares carefully. Using algorithms, they distributed their sales across multiple sessions, avoiding sudden drops that would alert the public. They were unwinding positions in silence, shedding risk without setting off alarm bells. David Chen, who manages billions at a major insurer, summed it up privately. "We are trying to protect long-term capital," he said, "but it is hard when everything about this company is moving in the wrong direction." Publicly, he said nothing. Even the boldest Tesla supporters grew cautious. Cathie Wood's firm still projected Tesla would reach $2,600 per share by the year 2030, but others in the analyst community quietly slashed internal estimates. Some began placing bets on competitors. Retail investors, unaware of this quiet retreat, kept buying. They believed the dip was an opportunity. In reality, they were absorbing the risk that Wall Street was offloading, setting the stage for an even larger blow. The production reality check. The idea that Tesla might fail to sell what it builds once seemed laughable. Now it was becoming unavoidable. At the Austin Gigafactory, managers issued a startling directive during Memorial Day week of the year 2025. Pause assembly of the company's most profitable product, the Model Y, not for parts shortages or maintenance, but due to insufficient customer demand. Employees like Maria Rodriguez were stunned. She had worked at the plant since the year 2021, back when 12-hour shifts and relentless overtime were the norm. Now she found herself sweeping floors and attending safety trainings, unsure when production would resume. "We are idle, but everything around us is still moving," she said. "That's the scary part." The Cybertruck inventory added another layer of concern. More than 10,000 units, worth an estimated $200 million, sat unsold. Some belonged to the Foundation series, discontinued in October of the year 2024, yet still waiting for buyers half a year later. It signaled something far worse than temporary sluggishness. It hinted at misjudged demand on a massive scale. The factory had been designed to churn out 250,000 Cybertrucks per year, yet Tesla struggled to move 40,000 units, despite aggressive pricing and federal tax incentives. Capacity had become a burden. Idle equipment, reallocated workers, and shrinking overtime reflected a new era, one of restraint, not expansion. Those changes rippled outward. Contractors were dismissed. Suppliers trimmed forecasts. Across Texas, the silence of unfinished Teslas echoed through communities built to support their success. What truly broke investor faith was not a product delay or even poor quarterly earnings. It was the collapse of expectations. The expectation catastrophe. Tesla had built its brand and its market valuation on the idea that it would always over-deliver. Now it was under-delivering, and investors no longer believed the excuses. The most glaring example was the Cybertruck. Elon Musk once hinted that the vehicle could reach 500,000 annual sales. Over 1 million customers placed deposits. Yet in its first year of full production, Tesla moved only 39,000 units. That gap between hype and reality destroyed credibility. Jennifer Walsh, who placed her deposit deposit in the year 2019, canceled her order in April of the year 2025. They kept changing the price. They removed features. It just was not the same truck I signed up for, she explained. Her voice joined a growing chorus of disillusioned early adopters. Even the Model Y, Tesla's crown jewel, began showing signs of market fatigue. Despite receiving a refresh, it faced demand shortfalls, prompting Tesla to scale back production. No vehicle in the lineup felt safe. Meanwhile, rivals surged. BYD surpassed Tesla in European electric vehicle sales. Ford, Hyundai, and General Motors offered compelling alternatives with better after-sales service and fewer broken promises. Chinese brands gained traction globally, eroding Tesla's dominance. Wall Street no longer trusted the forecasts. Every quarter, expectations had to be revised downward. The bold future priced into Tesla's stock began to look like a fantasy, and the market started bracing for what would happen next when belief finally gave way to doubt. We pulled factory data, inventory reports, and insider layoffs to map the collapse. Now you know what's really behind the silence in Tesla's gigafactories. If that saved you hours, hit subscribe and tell us what stood out. The silence inside Tesla's Austin facility did not signal peace. It signaled collapse. Ghost shifts at Gigafactory, Texas. Production lines that once operated 24 hours a day now sat idle. Workers who had been celebrated for overtime hours and breakneck assembly schedules suddenly found themselves mopping floors or sent home with pay. They called it the Great Pause. It began during Memorial Day week of the year 2025. Tesla quietly issued a directive: stay home or come in for cleaning and training. There were no parts shortages or weather disruptions. There were no logistical bottlenecks. There were simply too many vehicles already built and not enough buyers left. Rosa Hernandez had uprooted her life from Detroit to Austin in the year 2022, drawn in by Tesla's promise of high-paying, stable employment in a revolutionary industry. Now she swept hallways where Cybertrucks once rolled off the line. Her story echoed across the workforce. Overtime was the first thing to vanish. Then came shift reductions, followed by general reassignment to maintenance roles. Surveys circulated with vague options: reduced hours or transfers. It was framed as workforce optimization. Employees saw it as the beginning of a downturn with no clear ending. Outside the factory, Austin's restaurants and home sellers noticed the slowdown too. Lunch rushes faded. Local contractors lost business. Tesla had not just scaled back production, it had disrupted a city's economy. Beneath the corporate slogans, workers began drawing up backup plans, realizing that if Tesla's growth story was ending, their own futures might have to be rewritten. The Cybertruck Graveyard. In dozens of cities across the United States, rows of silver trucks sat in silence. Tesla's Cybertruck, once hailed as the company's boldest move, had become its biggest liability. Delivery centers became storage lots. Thousands of units gathered dust, becoming a monument to demand Tesla thought existed, but never did. More than 10,000 unsold Cybertrucks sat across Texas, California, and beyond. Roughly $200 million in unsold assets filled these lots. The oldest units dated back to January of the year 2025. Some belonged to the Foundation series, discontinued in October of the year 2024. Still, they remained parked and unwanted. Marcus Thompson, a delivery manager outside Houston, stared at the vehicles every day. These are not just trucks, he said. They are someone's missed projections, someone's failed strategy. The financial pressure grew with each passing day as insurance, depreciation, and maintenance chipped away at margins. Tesla tried to fight back. It slashed prices, offered 0% financing, and pushed rebates, once unheard of for a Tesla product. Yet customers waited, knowing they held the power. Dealerships struggled to create urgency when supply overflowed. Early adopters suffered the most. Used Cybertrucks flooded the market, driving resale values down. Many owners now owed more than their trucks were worth. Confidence in the product and in Tesla sank accordingly. As the trucks continued piling up, the company's most ambitious launch began to look like its most devastating mistake. Tesla was not leading a revolution anymore. It was drowning in its own overconfidence. Assembly line anxiety. Within Tesla's factories, a different kind of stress emerged, not from overwork, but from underwork. Metrics that once rewarded high output were replaced with goals emphasizing restraint. Employees who had taken pride in setting records now learned to operate in reverse, doing less, slower, but still perfectly. Miguel Santos, who led final assembly for Cybertruck production, found himself in uncharted territory. "I used to be celebrated for pushing volume," he said. "Now I am congratulated for scaling it back." The psychological shift was jarring, especially for workers whose entire careers were built around efficiency and growth. Workers were cross-trained across vehicle lines, but it no longer felt like advancement. Instead, it felt like preparation for uncertainty. Model Y teams absorbed excess staff, but those integrations created logistical snags. Training took time, procedures varied, and output still had to match sagging demand, not previous records. Schedules changed too. Some employees worked just 3 or 4 days per week. Others clocked full-time hours but spent them organizing tools or cleaning equipment. Productivity no longer defined success. Flexibility and morale management took center stage. The break rooms changed with the factory floor. Conversations turned from bonuses and output to job postings and potential layoffs. The culture of winning began to feel like a culture of waiting. Management revised evaluation systems. With output no longer king, workers were judged on adaptability and soft skills, but those metrics lacked clarity and morale dipped further. The machinery was still running, but the spirit that powered it was grinding to a halt. What happens when the world's most anticipated vehicle becomes its biggest burden? Tesla was finding out in real time. The inventory avalanche. The Cybertruck overstock had grown from a temporary headache into a strategic threat, one that was freezing cash flow, damaging brand value, and throttling growth. Each unsold truck represented roughly $20,000 in annual overhead. Multiply that by 10,000 and the cost ballooned to $200 million. These were not just parked trucks, they were assets consuming resources, space, and capital. Tesla no longer had an abundance. Delivery centers overflowed. Parking lots turned into long-term holding zones requiring weatherproofing, security, and routine maintenance. Some centers could not even accept new units. Cybertruck production was overwhelming distribution capabilities. Suppliers who had invested in Tesla-specific tooling found themselves with idle factories and warehouses full of parts. They had ramped up expecting historic demand. Instead, they received halted orders and frozen contracts. Consumers recognized the glut and adjusted accordingly. Waiting became the smart move. Negotiating power belonged entirely to buyers. Expectations for even deeper discounts triggered purchase delays. The longer trucks sat, the worse Tesla's margins became. Used Cybertrucks lost value at unprecedented speed. Owners who had taken delivery in the early months found themselves upside down on loans. Tesla's once fanatical community of brand loyalists now expressed frustration and regret. Tesla's ability to invest in future models was quietly undermined. Capital that could have funded new initiatives was trapped in inventory lots. As cash flow slowed and carrying costs grew, even bullish investors started asking the hard questions. The $56 billion question. The headlines focused on the number, $56 billion. But the real issue wasn't the money, it was the message. A compensation package of that scale didn't just challenge norms, it tore them up and dared the world to object. In January of the year 2025, a Delaware court shocked shareholders by voiding Elon Musk's record-breaking pay agreement, ruling that the board had failed to act independently. The verdict exposed uncomfortable truths. Tesla's board had been, in essence, rubber stamping the will of one man. 304 million stock options were suddenly under legal dispute. Tesla's valuation swung wildly as investors tried to parse the implications. A hastily assembled two-person committee was tasked with designing a new compensation structure, but trust had already been shaken. Ann Wilkins, a Tesla shareholder since the year 2018, had voted for the original package. Now she regretted it. "I believed he earned it," she said, "but I didn't realize how little oversight there really was." Institutional shareholders, BlackRock, Vanguard, the California Public Employees Retirement System, began signaling discontent. Proxy advisory firms issued new voting guidelines, warning about excessive executive control and the dangers of entrenchment. What was once framed as visionary leadership began to look more like unchecked dominance. And with Tesla's financial position weakening, the question of who truly controlled the company had never mattered more. By the time the board began considering alternative options, it was clear Tesla's governance structure was no longer an internal matter. It had become a global risk indicator. We connected the dots across court rulings, inventory data, and market reactions. Now you've seen the collapse before the headlines even caught up. up. If that gave you a head start, subscribe and let us know what surprised you most. Political distractions and business consequences. Tesla's customers weren't just walking away from products, they were walking away from a persona as Elon Musk's political engagement deepened. Whether clashing with regulators, endorsing controversial candidates, or debating immigration policy on social media, consumer sentiment shifted. And this time, it wasn't just critics noticing. Internal data from early 2025 showed a surprising trend. Negative sentiment toward Musk now correlated directly with declining intent to purchase Tesla vehicles. The connection was strongest among younger, urban, and first-time electric vehicle buyers, once the bedrock of Tesla's customer base. Employees noticed the shift too. Workplace forums buzzed with concern about the blurred line between personal politics and corporate image. Some team members at the Fremont facility quietly transferred to other divisions. Others updated resumes. Tesla's sales team faced the front line of the fallout. Stephanie Grant, a delivery advisor in Seattle, described customers canceling Model 3 purchases after Musk's high-profile social media rants. They didn't say it was the car, they said it was him, she explained. Meanwhile, competitors moved in. Hyundai and Ford increased market share in coastal cities where Tesla had dominated. Chinese brands gained a foothold in price-sensitive segments. Even Lucid and Rivian, once niche players, saw modest gains as Tesla's image tarnished. The impact wasn't just reputational, it was transactional. Social media engagement dropped. Brand perception scores declined quarter over quarter. Tesla's own data showed that Musk's visibility now created as much harm as good. The brand that once stood for innovation now risked being defined by controversy. And in an industry driven by trust, that was a risk no company could afford. The control paradox. Tesla was always Elon Musk's company. That used to be a strength. Now it looked like a liability. Musk's influence extended beyond vision and innovation. It reached deep into Tesla's operational structure, governance, and public image. He controlled roughly 14% of voting shares directly. But with board allies and passive shareholder support, his real influence was far greater. Investors once saw that control as protective. It allowed bold bets and rapid innovation. But as Tesla faltered, financially, operationally, and culturally, that same control began to look like a chokehold. An internal audit conducted after the Delaware ruling revealed troubling patterns. Board members had approved strategic shifts with minimal debate. Critical risk disclosures were delayed. Major policy changes, including factory schedule revisions and advertising strategies, often bypassed full review. Mark Kelly, a governance analyst at EquiWatch, summarized the problem bluntly. It's hard to hold someone accountable when no one's empowered to question them. Employees echoed the sentiment. Some applauded Musk's relentless drive. Others, like former engineering manager Darnell Washington, felt boxed in. You couldn't propose anything that wasn't already his idea, Washington said. It wasn't a team, it was a monarchy. Proxy battles loomed. Institutional investors began pressing for board expansion and independence benchmarks. A movement to separate the roles of chief executive officer and board chair gained traction. What had started as a leadership cult was now becoming a cautionary tale about over-centralization. The paradox was inescapable. The person who built Tesla into a juggernaut might also be the one holding it back. And in a volatile market, that was no longer a philosophical debate. It was an existential risk. Trust erosion and brand toxicity. For years, Tesla didn't advertise. It didn't need to. Its customers were evangelists, and its products were symbols. But by the middle of the year 2025, that trust-based marketing model had imploded. Brand perception data told the story. Net promoter scores, once in the 70s, fell to the low 40s. Surveys showed that over 25% of previous Tesla owners would not recommend the brand to friends or family. The reasons varied: inconsistent quality, service issues, and most strikingly, discomfort with leadership. Marketing teams scrambled. They launched campaigns emphasizing engineering excellence and environmental values, quietly minimizing Musk's image. Sales representatives received training on how to redirect customer conversations when leadership controversies came up. It wasn't enough. Social media platforms that once boosted Tesla's every move now hosted skepticism, memes, and viral rants. A single bad service experience could reach millions within hours. Customer defection rates to Ford, Kia, and BYD spiked, especially among younger and first-time electric vehicle buyers. At the retail level, the change was visceral. Sales consultant Jasmine Lee described described customers entering stores looking for reasons to walk away. They liked the vehicles, but not what the brand had come to represent. Even longtime fans voiced regret. "I loved my Model S," said Kevin Malone, a tech executive from San Diego, "but I won't buy another. I just don't want to explain it anymore." In business, reputation moves slower than revenue, until it doesn't. And for Tesla, years of goodwill evaporated faster than any quarterly earnings report could recover. The loyalty that once shielded the company had become fragile, and the shift wasn't subtle, it was seismic. The Chinese electric vehicle invasion. The alarm didn't ring in California or Michigan. It rang in Berlin when BYD outsold Tesla across Europe for the first time. To most consumers, the name BYD was still unfamiliar, but inside the industry it had become synonymous with speed, scale, and precision. Backed by Chinese industrial policy and armed with cost advantages, BYD expanded like a storm system. First saturating domestic markets, then Europe, then Latin America. North America was next. In the first quarter of the year 2025, BYD shipped more battery electric vehicles into Europe than Tesla, a market Tesla once dominated without competition. While Tesla leaned on past reputation, BYD flooded the market with new models like the Seal and Dolphin, priced well below the Model 3 and featuring comparable range, fit, and finish. For consumers facing inflation and shrinking subsidies, the choice was easy. Tesla's cost structure couldn't compete. Chinese EVs were on average 20 to 30% cheaper than their Western rivals. The reason? A vertically integrated supply chain, domestic mining access, and low-cost labor, all leveraged at national scale. In Norway, once Tesla's crown jewel market, BYD doubled market share year over year. In Germany, Volkswagen's homeland, Tesla's deliveries dropped 9% while BYD gained 15%. European incentives began to favor local or partner-assembled EVs, something BYD quickly exploited. For American workers, the implications were haunting. As Tesla stumbled at home, jobs vanished overseas, and competitors captured the future it once owned. This wasn't just about cars. It was about whether the American electric vehicle dream would be made in America or made irrelevant. Irony hung thick in the air. The same companies Tesla once mocked, General Motors, Ford, Stellantis, had become its biggest threat. Detroit's electric revenge. For over a decade, Tesla had humiliated Detroit. Legacy automakers were dismissed as slow, bureaucratic, and obsolete. They were late to electrification, cautious in rollout, and burdened by dealer networks and union contracts. But in the year 2025, that slow and steady approach suddenly looked like wisdom. While Tesla wrestled with inventory problems, Ford's F-150 Lightning production increased 12% quarter over quarter. General Motors began delivering the Silverado EV in volume, and their Ultium battery platform gained reliability recognition from major testing bodies. Most critically, traditional automakers understood after-sales service. Customers sick of waiting 3 months for Tesla repairs found refuge in nationwide dealer support networks. For buyers in rural or suburban areas, familiarity and accessibility now trumped flash. Detroit's resurgence was not built on speculation, but execution. Investment flowed back into U.S. plants. Ford added 2,000 jobs at its Blue Oval City complex in Tennessee. GM announced new EV battery partnerships with South Korean and Japanese firms, bypassing some of the trade tensions that complicated Tesla's global supply chain. Even market sentiment shifted. Once dismissed by Wall Street, Detroit now looked dependable. Analysts upgraded Ford's and GM's ratings while cutting Tesla's. Institutional money followed. At one point, Tesla defined the future by what others lacked. Now the roles were reversed. Tesla lacked what its rivals had quietly restored: operational discipline, brand trust, and product relevance. Detroit wasn't catching up. It was pulling ahead. For years, being first meant being best. Now it just meant being copied. The innovation trap. Tesla's innovations, over-the-air updates, gigacasting, proprietary drive units, even vertical integration were no longer unique. Rivals had borrowed, reverse-engineered, or leapfrogged every advantage Tesla once held, and they were executing better. Take battery technology. Tesla's much-hyped 4680 cells remained in limited deployment with yield and consistency challenges. Meanwhile, Chinese firms like CATL and BYD developed high-volume lithium iron phosphate variants with better thermal management and lower cost. Solid-state prototypes emerged in Japan. Hyundai made significant strides with battery-swapping partnerships in Asia. The result? Tesla's edge dulled. Manufacturing quality also suffered. Consumer Reports, dropped Tesla's reliability rankings after a surge in service complaints. J.D. Power's latest survey placed Tesla below industry average in initial quality. Buyers who once tolerated quirks for innovation now demanded consistency and were finding it elsewhere. Tesla's software advantage also narrowed. Advanced driver assistance systems from Mercedes-Benz and BMW received regulatory approval for hands-free driving on European highways. Tesla's full self-driving remained in beta, marred by legal challenges and public scrutiny. Even brand identity suffered. What used to feel revolutionary now felt incomplete. Raymond Liu, a former Tesla supplier liaison, put it bluntly, "They led a gold rush, but forgot to build a bank." Innovation without scalability became a trap. First-mover advantage turned into infrastructure disadvantage. What once made Tesla untouchable now made it vulnerable. In tech, disruption is the beginning. In automotive, it must become tradition. Tesla was stuck between the two, and the window to recalibrate was closing fast. Tesla created the modern electric vehicle industry. But by mid-year 2025, the industry no longer needed Tesla to survive. Survival or extinction. Investment banks began circulating survival models. The numbers were stark. For Tesla to return to profitability at previous margins, it would need to sell nearly 800,000 vehicles per quarter, while cutting costs by 20% and raising prices 10%. None of those conditions seemed achievable in the current market. Analyst projections showed worsening trends. Piper Sandler revised its 12-month price target downward by 30%. Goldman Sachs removed Tesla from its conviction buy list. Credit rating agencies placed Tesla on negative outlook due to liquidity pressures and governance instability. Internally, Tesla paused multiple projects. The next-generation compact car, once slated for early development in Mexico, was quietly delayed. International expansion into India was shelved amid regulatory friction. Even advertising pilots were suspended due to budget constraints. Tesla didn't just build cars, it built an identity, a movement, and an expectation of endless dominance. Now, as longtime employees leave, budgets tighten, and shareholders question everything, the future feels anything but certain. So here's the real question. Can a company survive after losing the very belief that made it powerful? Can the mission outlive the man who created it? And if Tesla vanishes, what replaces it? Let us know in the comments. Thanks.